Yeah, yeah.
Okay.
It is
Yes,
visible.
sir.
Okay. Okay.
Yes, sir.
So I'll start today's market talk. What I wanted to say is, as has been brought out, that markets are at pretty high levels, is that as we understand margin of safety, it is in the durability of growth. So, a margin of safety is the one which protects the investors from unexpected declines. But what we need to do is we need to estimate the growth rates of the stocks or the markets based on performance of the business over years and the growth trends, and then invest in that. So, in case the stock is going to perform, there is going to be inherent margin of safety if you hold the stock. And the other thing which I have realized is that the most of the investing and trading game is played out in the mind. And it is very amazing to see people talking about fundamentals and technicals. It is the mind which is the most important issue. Okay. As the market status, as I see it, interestingly, both the US Fed and European Central Bank increased their policy rates by 25 basis points. So if you see the US, the employment rate is around 3.6%, unemployment rate, which is down. The next meeting is in, I think, 19th to 20th September. So there is clear 2 months available. So inflation data can be soft and the growth data can be wherever it goes. So there is a likelihood that Fed may pause, and US GDP growth is strong. It came around 2.4%, stronger than expectation. So if the job market is strong and the GDP is strong, then and the inflation goes down, then there is a possibility of a pause in the uh, next Fed meeting. Now, interestingly, the Bank of Japan tweaked his bank's long-standing yield curve control policy by increasing the limit up to which they would allow the Japanese government bond yield to move to 1%. They had moved it from 0% to 0.5 earlier, and now they have moved it to 1%. Now, what this will do is this will allow the Japanese government bond yields to move to around 1% from where they are now. It will harm the carry trade. Carry trade is basically borrowing in cheap yen and then investing in high yielding assets across the world like India or other emerging markets where the interest rates are higher. Trigger is high inflation in Japan, and just because there is high inflation in Japan, Japanese markets are doing well, and even Mr. Warren Buffett was talking about investing in Japan. Now, uh, as we see our results, the banking and finance pack has been doing exceedingly well. So this is one of the reasons why I chose to discuss Bajaj Finance, one stock from this pack. It gave 32% rise in net profit year on year, solid growth in assets and better asset quality. Net interest income has increased 27% year on year. AUM is roughly 2.7 lakh crore, and they are lending to everyone: consumers, SME, rural, mortgages, home loans, securities lending, everything else. And now, home loans is their second largest business after consumer financing. And home loans is a better business because it has got longer gestation period and longer revenue visibility. They had a return on assets of around 5.42%, and guidance is of lower cost to income ratio. So, with a guidance that is of 25 to 27% growth, assets quality good, return on asset roughly around 4.5 to 5%, and a profit growth of around 23 to 24%, it is looking good. But it is at 5.3 times price to book. While relatively, HDFC Bank, which has similar growth and similar asset quality, is at 2.1 times price to book. So that's why people are becoming jittery that it is becoming expensive. Now the other point is about IT sector. The results continue to be weak, and that is why I selected Tech Mahindra. The results were howler. Revenues were down, margin collapsed, the order inflows slowed down. The constant currency revenue growth was minus 4.2% due to decline in communication vertical. That is the basic point, is that Tech Mahindra The basic thing is like they provide software for the communication vertical. US was pretty flat. There is a decline in Europe, and rest of the world, due to spending cuts in telecoms, is also seeing a decline and less of new orders. So margins were down around 450 basis point to single digits. So it has to correct meaningfully from here to be of some value. And same is the problem with most of the IT stocks. So the point is, are the markets overvalued? This is what is troubling a lot of people. The point is that I feel that the markets are expected to be volatile until fundamentals catch up with valuations. Now, things like M&M, Mahindra and Mahindra, which did some kind of a interesting acquisition of RBL, some stakes, minor stake in RBL, the ITC demerger, such kind of disappointments and other earning weaknesses can spook the market quickly because it is at a very high pedestal and it is too good to fail right now. So valuations, though, are still cheaper as compared to what they were in October 21. Relatively, they are cheaper. So, and as we have all seen, it is just the liquidity which is driving the market. It is all the FI buying and all that which is buying. And interestingly, if you see, the mutual funds have been selling. A lot of mutual funds are sitting on cash now. Like I spoke to one of the mutual fund guys. they, some of their big funds, they are sitting on a lot of cash to the tune of 10 to 15% now. So one has to be very careful. Now, as I was talking about the Nifty technical levels, as I see, this was the basic level around 18600 from where the market had taken off, and it had gone and touched nearly 20,000. Now, what I feel is that now the market is in a retracement, and it may either test 19470 or the 0.5 or 50% retracement level of 307, or on the worst case, the 38% retracement level of 9144, 19144. But all of them are going to be good buying opportunities. So we have to wait for these retracement levels. And right now the market has gone down below the 50 EMA. So right now it is looking slightly weak. So we have to see these levels, and in case they get tested, and then the buying will come because a lot of people are sitting on liquidity. Now, talking about the broader markets, this is the index of Nifty 500 over last 4 5 years. If you see, this this index is in a clear breakout. So even if Nifty, which has got just 50 stocks and a skewed index where RIL and HDFC Bank are very important parts, here it's since a broader market, 500 stocks. So here you can see there is a clear, on a monthly chart, you can see there is a clear breakout. So the broader markets till the time they are doing well, there is still hope and portfolios are likely to do well. Now coming to today's stocks, first is I'm going to discuss is Praj Industries because this is one of a very important stock in terms of industrial growth because ethanol and fuel and green energy is a big concept. So what Praj did was they started as a supplier of ethanol plants, and it is a global company providing various solutions with a focus on environment, energy, and agri-process industry. Now, the product portfolio is diversified into bioenergy, high purity systems, and engineering products. So, bioenergy is a key part of the portfolio, roughly 71%. Now, there is a demand for low carbon ethanol in US. Ethanol made from ATJ, that is alcohol to jet fuels process, has the lowest carbon emission. Demand for SAF, that is sustainable aviation fuel, would increase the demand for ethanol and also for commercial benefits ethanol offers. Advancements in CBG business. CBG is compressed biogas. So first rice straw based commercial plant for HCL has commenced biogas generation. We have to factor in higher margin from new projects because they are getting into high margin businesses, increased share of exports, and softening of raw material prices, which will help in stabilizing the margins. The company is witnessing traction and positive development in the USA for 1G ethanol and Europe Union, where they are seeing 2G ethanol requirement. Now, just for information, 1G ethanol is uh, which uses basically starch as a source of sugar, which comes from wheat, corn, barley, sugarcane, etc. The 2G one use cellulose and hemicellulose at a source as a source of sugar that comes from waste, wheat straw, corn, wood, agriculture residue, etc. So it is a better technology which these people have developed. They have received the first order from semiconductor business in its high purity segment also. It is that high purity segment which is higher margin businesses. So let's see their quarterly results. If you see, the sales are going up now. There is more demand. Uh, the margins are roughly at around 9 to 10%. The incomes are going up, profit is going up. So the stock is in a uptrend. And if you see the growth prospects, the margins are likely to be going higher for this financial year. In the next financial year, roughly 40% is going to be the gross margins, and PAT margins are going to be around 8%. So there is going to be better margins, so higher profits. The sales growth is expected to be between 16 to 10%. EBITDA growth again 43 to 18% because of higher margins, and PAT growth is supposed to be higher. They are becoming efficient, improving all their liquidity and other ratios. EPS is roughly going to be 20 times 20 rupees for this financial year. So at around 20 times, I don't think for FY25 earning it is expensive right now. The adjusted PE is around 18. That's what I was saying. At around 20 times, it is not expensive with the growth and the niche business they are having. The ROE is again improving. If you see, next year, this year is supposed to be 27%, and ROC is 35%. So as the ROE improves, the profits improve. Now, seeing the chart, it went to highs around October last year. Then it had dipped in March to around 300 levels. Now it is somewhere around 400 plus. It has reached these levels, and a level of 390 where the 50 EMA is there would be a nice level to enter this stock for long term. Now next is about Triveni Turbine. The point here is that the industrialization and the manufacturing is the key growth area for the economy now, with the government's endeavor to support these sectors. So one of the stocks is Triveni Turbine in this field. It is primarily engaged in the business of manufacture and supply of power generating equipment and solutions. It's a market leader in steam turbines up to 30 megawatt in India, and also largest manufacturer of industrial steam turbines globally in 5 to 30 megawatt range. It has 60% market share in the domestic steam turbine industry, and post its exit from a joint venture with GE, the company is now focusing on increasing the market share in the high margin 30 to 100 megawatt export market directly. So order book is at all-time high, roughly 1328 crores. That is 1.1 times trailing 12 months revenue for FY23. So it has a visibility of revenue for FY24. Export revenues grew by 122%, which is because of aftermarket business. There is a big demand for space and refurbishment. As a result, domestic export mix came in at 57 to 43%, and that is where it is improving from around 70-30 last year. Prospects are good for distillery, sugar, food, and pharmaceutical industries. The key issue is margin expansion, which is going to drive the product mix, higher share of exports, and easing commodity inflation are in place. However, the company need to focus on growing the top line. So we as investors have to watch, is the revenues growing or not growing. So if you see the quarterly results, uh, if you see there is a constant increase in the revenue. The margins are nearly around 18 to 20%. Profit is improving, and net PAT and net EPS is also growing. Let's see the future. If you see, there is a likelihood of revenue growth. So it's expected to be more than 2,000 crore this financial year. So the PAT and the operating margins are going to improve. EPS is expected to be around 10 for FY25. So that gives them a PE of around 40 to 35. So this with a better ROC because of better margin businesses. So this is the stock to be kept in mind. Now, but it had a vertical rise from last year onwards, and now it is consolidating. So I would not just jump into it immediately and wait for at least 50 EMA and the results for this quarter to get into this, because uh, everybody was buying this stock, and from here onwards, that is January this year, it had a vertical rise up to say around 420 plus. So this has to consolidate. It has become too expensive, and we have to see the results. Next is SKF India, is a leading supplier of products, solutions, and services within rolling, bearing, seals, mechatronics, and lubrication systems. SKF boasts a debt-free balance sheet, which is very important because it's a debt-free company, coupled with consistent ROCE and return on invested capital upward of 20%. It is poised to benefit substantially from the healthy domestic demand from industrial segments, led by further revival in private capex and pickup in demand from automotive segment. They are participating in this freight wagon tenders from railways. So it is also a play on the railway growth and wagon story, expanding the network of dealers and launching new products. Now, again, if you see the quarterly results, results are revenues are growing. It had a dip in last quarter because of higher expenses, higher cost of input materials, etc. So the operating margins had dipped, and so the profit had also dipped. But this quarter or next quarter are likely to be better because is a key, bearing as a key requirements of any industrialization or any industrial economy. So if you see, we are expecting a 3 year CAGR growth of around 14 odd percent for next 2 to 3 years, and EBITDA growth of approximately 20% is expected. Net profit is also expected to grow around 20%. So if you see, the present EPS is 106 bucks. So if it becomes F 152 in FY25, so it goes to below 30p right now. So that is why there was a recent movement in this stock, and the stock price has crossed around 5,000. And ROC and ROE are good, and these businesses are the ones which are generating free cash flow. And this is a market leader along with Timken in the bearing uh, industry. Now, if you see the chart, again, it is just come below, it came below its 20 EMA and just immediately rebounded on Friday. So the buying came. That means there are strong hands which are getting into this, and weaker hands are getting out because moment must have crossed 5,000. Probably people would have sold out, and it is above all these moving averages. Hence, it's a good stock to buy at all dips and all moving averages. So this is about the stocks. Now let's talk about the covered call strategy. Why I am discussing this stock is this strategy is basically in reference to a stock which I'll cover subsequently. That is ICICI Bank. So covered call strategy is an option strategy where a trader combines owning the underlying asset along with an option contract on the underlying. So you hold a Nifty or a stock in your portfolio, and you have an option contract of the same stock. So you hold a long position in a security and simultaneously write or sell a call option of the same security to gain profits in the form of premium. So appropriate time to invest during this strategy is when you predict a moderate or neutral market. Like even if like we are seeing now, The Nifty is going up, but ICICI Bank has been stuck in this 950 to 1000 odd range. So this is a good strategy in case you are holding this stock. As the trader is aware, he can't make good profits just by holding on to underlying asset, because if you're holding asset, it doesn't give you any profits. So you can add on to your income by selling call options on the security. Only thing you have to do is you have to sell it at a higher strike price and earn premiums till that strike price is reached. You can generate a steady income from an asset which is usually not profitable due to volatility in the market. Now let's see this. So this is first strategy is about a covered call against portfolio holding. So let's assume that I am holding 700 shares of ICICI Bank in my portfolio, and the current market price is 995. My buying price is not important. The current market price is 995. So what I do is I select a strike approximately 5 to 6% away from CMP, or a strike with maximum OI. Now there are reasons for this. This is very important to understand. If you see the backtested data, the average ICICI Bank has never moved more than 5 to 6% away in a month. And generally also, if you see the strike where there is in call options where there is maximum OI, the stock in cash market hardly crosses that level where there is maximum OI, unless there is something drastic which is there with the stock or some very good news is there. So that gives the limit to the upper range of the stock. So I'll show you the this thing, ICICI Bank option chain. Now, if you see this option chain of ICICI Bank of next month expiry, so this is call side, this is put side, sorry. Now, if you see the strike price 1020, 1050, and 1100 have got the highest open interest, which is here. Now I also want to earn some premium also, and I want to see that 5 to 6% margin of safety while selecting a call. So I select this 1050 call. It has got sufficient amount of open interest also, because this 1020 is too close. So it can go above this very quickly. But and this is too far and premium is too low. So I my aim is to make some additional profits also every month. So I select this 1050 call. So what do I do is I select a strike which is 1050 at the rate 8 rupees. The presently this it was below, but I wait for it. If it goes up another 4 5 rupees, the stock, this 8 rupees will be achieved. I want to make at least 1% return by selling this call. So my position would be holding 700 shares of ICICI Bank, which is one lot, and 1050 C, which I am going to sell at the rate 8. Now, what happens is if the stock say remains at 990 till expiry, present market price is 995 till August expiry. Since I'm expecting the stock to remain at these levels only, or generally move around these levels, say it has gone to 990 till expiry, my loss in cash is 5 rupees into 700, that is 3500, and gain is premium, because if it remains at 990, the this call option will which I have sold will expire worthless. So I will gain the complete premium, which is 8 into 700, that is 5600. So my net gain is approximately 2100. The other advantage is that though I am holding the stock, so this price movement is variable. So actually you are gaining extra premium every month by this strategy. Now what happens is if the stock price goes above 1050, you have to give delivery. So the stock gets sold at 1050. So in whatever price you may have bought it at say 900, now you have to give the delivery at 1050. So the stock price may have gone above 1050. Now what do we do now? So moment the stock price say goes to 1060, and you have given the delivery of your stock on expiry, Now, for the next month in September, what you do is you sell a put option of strike 1050 or lower as per your expectation for the next month. So what happens is if the strike price or the current market price keeps going above, you will make returns because you have sold a put option of strike 1050. So if it goes above 1060, you will make returns on that. And in case it reverts to 1050, you will get back your stock in your portfolio. And then you can restart that strategy of selling the calls. The point to note is that stock will not move in one direction only. So this volatility will be there. Only thing is you can generate your holding cost of the stock. What I mean to say is, if I have bought, say, at 900 rupees ICICI Bank and it gets stuck between 950 to 1000 for 1 year, that means it has not given me hardly any. It has given me hardly any return. So my holding cost, if I see, is, let's say, assume is the what is the interest a saving bank account generates? It's around 5 to 6%. So if I had, so opportunity cost of 5 to 6%, which would have been otherwise generated through keeping it in a saving bank account, has been generated by either selling calls or selling puts, depending on the price movement of this stock. But the point to note is this is only for stock which is not expected to move much. If the stock is expected to move much, move in either direction in a bigger way because of some events, then it is better to take a different strategy. Then you don't have to take this strategy. So now there is one more thing. The other, this is in case I am holding it in my portfolio. If I want to do this for trading, so what I have to do is, if I am not holding this stock in my portfolio, I buy a futures of ICICI Bank at 995, which is the current market price, and then sell out of the money option call of 1050 at the rate 8. After that, my gains and everything is the same, because in case I have to give delivery, then I have already bought a future and I can give delivery in case it goes to 1050, though I will make returns because of I have got a future. So the point to remember here, again I will reiterate, in case a short call strike becomes in the money on expiry, you have to give delivery of the stock. Again, I'll say, if a short call strike, that means if you have sold a call of 1050 of ICICI Bank and it becomes in the money, that is, the price becomes 1050 or above on expiry day, you have to give delivery of the stock. So this you have to keep in mind. And in case a short put strike becomes in the money on expiry, that means if the stock price had gone to 1060 and you had next month sold a put of 1050, so a short put strike becomes in the money. That means if the stock price again goes back to 1050 or below, depending on your put you have sold, you will have to take delivery of stock in cash sec. So this is just this thing on selling calls. So I have finished. We will take questions now.